Hi everyone. Hi everyone. Good evening. I'm Daud Sharif, representing from Neo Asset Management. Ritu, first things first. Thank you so much for taking up this opportunity, and thank each and everyone for taking out time today. So quickly, before diving into the product, quickly wanted to introduce you Neo Wealth and Asset Management. We are an asset and wealth management company. So what we are doing is we are providing bespoke capital solutions to well-established companies while we deliver superior risk-adjusted returns to our investors. Neo was started back then in October 2021. In a journey of 3.5 odd years, now we are a 14,000 crore company, asset management company, where we are managing 14,000 crores of assets. We also have an in-house wealth division where we are managing for 50,000 crores of assets. This happened within a span of 3.5 years. We are backed by few of the marquee financial institutions and private equity investors. Mitsubishi UFG, the Japanese bank, has got an equity stake in Neo. Peak 15 has got an equity stake in Neo. Mr. Jim Simmons Family Office, the US-based private equity, venture capital fund, venture capital office, has got a stake in Neo. So we are backed by few of the marquee financial institution, including the private equity investors. So now we are a team of almost 50 plus members, dedicated 35 plus investment professionals for this particular strategy. What we are trying to do at Neo is we are trying to build a yield curve starting right from the Special Credit Opportunities Fund, which is our flagship fund. So this is a category 2 AIF, and we do have different strategies, right from private credit to real assets and core credit. So we also have a real assets fund where we essentially buy out these operating road and solar assets from counterparties such as NHAI and SECI. So that is one of the funds which is actually closed for subscription at the moment. And we also have India's only AA minus rated fund, which is an income plus fund on the performing credit space. Apart from that, any investor looking for um, a fund which gives a superior risk-adjusted returns at a gross level of 11 to 12% with steady liquidity, we have Neo Treasury Plus Fund and Neo Yield Enhancer. So Neo Yield Enhancer happens to be our debt PMS. So the fund in focus today is the Neo Special Credit Opportunities Fund. This is the founding team, Mr. Nitin Jain, the managing director and the chairman for the at the group level. He he joins Neo, and previously when he was with Edelweiss, he was managing 2 lakh crores of assets. Mr. Hemant Daga, ex CEO for Edelweiss Alternative Assets, has joined us. Now he is managing the entire business for asset management vertical. Mr. Daga, back then when he was with EAAA, was managing 1 lakh crores of assets across AIF and mutual funds strategy. Mr. Puneet Jain, the man behind the strategy, has been doing such kind of investments, special situations, almost for a decade. So he brings in almost a lot of experience. Ex Goldman Sachs, ex Kotak, has been doing similar kind of strategies back then when he was with Edelweiss as well. Recently joined Mr. Shivaji Devkar from 361. He has joined us and he is currently looking after the wealth business at Neo Asset Management. So this is the founding team, all IIT and IIM grads, having close to 2 decades of experience. Yes. Mr. Rubin Cheda has joined us for this particular strategy. It's not just Mr. Puneet who is looking after the entire strategy. Mr. Puneet, accompanied by Mr. Rubin Cheda, is running the show here at Neo for Neo Special Credit Opportunities Series 2. Yes, Mr. Rubin Cheda comes from ex-True North. He is ex-True North and he was managing a corporate lending book at Piramal, CDPQ. So he has joined us recently. So yes, speaking about the private credit. So today, when you look at private credit, globally, world's largest funds today are your private credit funds. One of a few of those private credit funds are Blackstone, BlackRock, and Oaktree. So very strong funds globally today, and has been attracted interests of many marquee institutional investors such as your pension funds, your insurance companies, and also sovereign wealth funds have predominantly invested in this particular strategy. So while it is always said to compare apples with an apple. But still, we want to compare this particular strategy with one of the finest equity markets globally, with the US equity markets. So, the top 25% of the funds, like I mentioned, the Blackstone, BlackRock, and few other funds, have outperformed the US equity markets in the last decade. So, and here is the maiden funds, which has eventually performed well in the last decade, surpassing the returns what have S&P 500 has delivered over the last decade. So the strategy is well tried and tested globally, while it is very new in our Indian markets. What is creating an opportunity for us, for asset managers like us, is very important. So previously, before 2019 and before 2019, we have seen how well banks and NBFCs were participating in the corporate lending when it comes to corporate lendings, right? So post the defaults of DHFL crisis, Lehman Brothers crisis, and ILNFS crisis, the ILNFS crisis which happened due to a very small reason, the asset liability mismatch, right? So this has shook the entire Indian banking system. So what the RBI has came up with the recent prudential norms is that the RBI told the financial institutions not to refrain from doing corporate lending, but to reduce the exposure right from doing corporate lending, and has emphasized the importance of doing the retail lending. So today you look at any bank, today you look at any NBFCs, what are they essentially trying to do? What are they doing, and who essentially are they catering to? It's the retail borrowers to whom they are essentially tapping to. So today you look at the bank, they're okay to give you a personal loan. They're okay to give you a short-term unsecured loan. You look at NBFCs, you have many other NBFCs out there in the market. They're okay to do a short-term unsecured lending to a retail borrowers. But RBI's post amendments in the RBI's prudential norms, which has clearly stated that banks and NBFCs has to reduce the concentration right from doing corporate lending to retail lending. They have reduced doing this particular lending for approximately 25%. So this is creating an annual opportunity for asset managers like us, private players like us. So what are we essentially doing in this strategy is lending against all the six end users. Today, funding towards acquisition, no bank or NBFC participates in such events. One-time settlement and uh, refinancing of your existing debt is prohibited. No bank will essentially give an exit to another bank because, like I said, the RBI's latest prudential norms that does not allow one bank to give an exit to another bank. Last mile financing is what we essentially look at, but we are not essentially lending to real estate companies, not essentially lending to companies, or essentially in the startup ecosystem. What we are doing is giving money to well established companies, taking a minimum of 2x collateral. Yes. And last mile financing, I would like to explain with an example moving forward. And loan against shares is something what we are keen upon. So today, if a promoter goes to a bank to borrow uh, certain funds from a bank, so there is a cap of only 20 lakhs. So over and above 20 lakhs, no bank and NBFC will essentially lend you. So that's when exactly all these situations gives us an opportunity to tap in. So exit to private equity, yes. One private equity fund cannot give an exit to another private equity fund. So one private equity investor cannot give an exit to another investor. So that's when exactly we come into picture. We do the lending at a rate of 22 to 23%. And obviously, not last but not the least, we look at stake enhancement as well. So these are the six typical end users what we essentially look at. And when I speak about lending, these are all the secured investments what we do. We essentially look at only EBITDA positive companies. We secure our lending by taking at least 2x of collateral. Today, if I am lending you, say for example, at least 100 crores, I'll make sure I have a security cover of at least a 200 crores. That's what we do. The fund is structured in such a way that it gives you a quarterly payout. So every we intend to deliver 4 to 4.5% of coupon. We intend to distribute 4 to 4.5% of coupon every quarter. And special situations in India is a synonymous to distress lending. But we are not essentially into distress lending. The companies, the counterparties whom we are tapping, whom we are essentially lending to, are all EBITDA positive companies. The promoters, they're all having a good intent to pay you back. It's not that we are doing any distressed lending, taking any turnaround calls. So in the fund's philosophy is such that only EBITDA positive companies complete escrow accounts, so that any erratic movement in the cash flows, we will have a close picture of it, and we'll restructure the deal as soon as we see any erratic movements happening in the company itself. So having a complete escrow account gives us complete access over the company's cash flows. Either we are the sole lenders in the system, if not, we are the senior secured lenders. That means we do not essentially have to go and take approvals of multiple lenders. Say, for example, a company has multiple lenders sitting on their books of accounts, right? Say, for example, there is HDFC, there is ICICI, there is SBI. So we do not essentially have to take an approval for these XYZ banks to get the collateral enforced during the time of any distress, or during the time of any defaults that this counterparty commits. So either we are the sole lenders in the system. What we ask the promoter and the corporate is to do that is borrow from us and give a clean exit to other lenders. That is the first situation. If things are not working out that way, we end up having the senior secured position. The fund the fund is well diversified. We are essentially investing in close to 25 to 30 trades, 30 companies. That's what we are ideally looking at. So speaking about Series 1 Neo Special Credit Opportunities Fund 1 was a 2000 crore fund where we raised almost close to 2300 crores. You are seeing a gross deployment numbers being a little elevated than the funds what we raised. This is because the 7 exits which happened in last year. So what happens, the moment this exits happen, so there is a commitment period right from the final close of the fund. So ideally, by next 2020, June 2026, in this period of time, we'll be redeploying the principal. So how many exits happened so far? 7, right? So the principal has got redeployed. So that is the reason we are seeing a little slightly elevated gross deployment numbers. So we have evaluated so far 510 transactions in this particular strategy from our fund 1. The opportunity to deploy money in this fund, in these strategies, is insane. Out of 510 deals, 10 deals what we evaluated, we have only invested in 25 companies. And again, like I said, the end users were these 6 end users: funding against acquisition, one-time settlement, doing the existing the one-time settlement and refinance of existing loans, last mile financing, loan against shares, and so on and so forth. So this is the fund structure. Would like to take a pause for a couple of seconds and would start over again with few live examples. Do you have any queries in terms of fund structuring, or what exactly is the fund philosophy? Would like to reiterate.
So now, firstly, on the audience behalf, I would like to ask, uh, private credit in Indian market. First of all, you said, because banks and NBFCs are not lending or not giving money to the companies. What's the reason why banks and NBFCs are not giving loans to those kind of a companies? Is there any kind of a risk, elevated risk involved in such kind of a companies?
So first things first. So like I said, against these 6 end users, RBI has come up with its latest prudential norms,
Hmm.
which is not allowing banks or NBFCs to participate in such events. The reason is simple. Like I said before, in 2019, the banking system has seen the ILNFS crisis. Before that, we have seen the Indian banking system has seen DHL and DHFL crisis, right? So post all these crises, so what RBI has decided upon is that they have asked the financial institutions to reduce uh, the end use, all six end users what you're looking at the screen. These are the 6 typical end users what RBI has limited their cap.
Okay.
has asked these financial institutions, banks and NBFCs to limit their exposure. So what is happening? This is creating an annual opportunity for asset managers like us. It's not that banks and NBFCs are not participating in such events. They are participating. But today, if any promoter wants to have, if any promoter have wants to obtain a loan against his own shares, right? There is a cap of only 20 lakhs, right? And at a sectoral level also, banks and NBFCs are not um, cannot fund more than 25% of their total AUM. So that is, there's these are the few guardrails which are essentially not permitting banks and NBFCs to participate in such events.
Okay. So basically, these are
So
the six
yeah,
whatever events you have shown is like where the opportunity is creating in this private market.
absolutely,
So if company would like to take a loan against share or one-time refinancing or settlement, or they are exiting from the private equity space, then they need fund and they need fund and bank and NBFCs cannot cater and then they come on the
absolutely,
private space to take
absolutely,
it.
absolutely.
Okay.
So when you look at this particular slide, so right from 2005, where you see banks and NBFCs participation, where you see a predominant participation from banks and NBFCs, close to 25%.
Hmm.
So things have changed over a decade. Today, you see banks and NBFCs are their rate of participation is close to 13%, right? And vice versa. And you look at how the rise of private equity has happened over the span of last 10 years. So banks, there is at one side banks and NBFCs reducing their exposure from doing corporate lending and has emphasis has spending more on essentially this retail lendings. So this is creating an annual opportunity for asset managers like us, for private players like us. And globally today, world's largest funds are private credit funds. Blackstone, you have Blackstone's private credit fund, you have Oak Tree. All these funds are globally the largest private credit funds. Today, when you look at the AUM, what private credit is essentially managing is close to 2.5 trillion USD. So that's how big the space is. That's how the AUM is 2.5 trillion, out of which 30% of the investable corpus has come from pension funds. One of the largest pension funds, Ontario's teachers, the Canada's pension funds, have got attracted to this particular asset class, owing the fact that, like I said, this particular strategy has outperformed world's finest equity markets in the last decade. Like I said, in India, yes, it is currently a 50,000 crores of annual opportunity, and there are only handful of players who are essentially able to cater such requirements. We have SBI, we have ICICI Special Credit, Special Situations Fund, we have EAAA, we have Neo Asset Management. But what differentiates us is that, like I said, special situations in India is synonymous to distressed lending. What I am saying here is that we are essentially lending to these companies, but not in a situation that these companies have ended up being in distressed. We agree that companies might have gone through some corporate restructuring, might have seen few IBC cycles as well, but we intend to deploy in this companies only when we see there is some profitability in this particular companies. Imagine if I'm giving a loan to any company, right? Today making an EBITDA of 100 crores, say for example, and he or she, or say for example, that particular corporate is already highly levered. He cannot service my debt. So the ideal debt to ratio in this particular strategy is 4 is to 1 when it comes to special situations. So anyone borrowing from us should have a debt to EBITDA levels of less than 4 is to 1. All secured investments that we look at, minimum 2x of security cover what we take, and we like traditional industries. We are not essentially investing in startups. not in real estate companies, not in any EPC businesses also. So we would like to invest in asset heavy industries where we can take plant property and PPE, basically plant property and equipment as collateral. On top of that, we see the kind of risk which comes when despite having such kind of collaterals. So it is very difficult to sometimes it is very difficult to enforce such assets. We do not sometimes we do not have such kinds of buyers in the market. So what we ask the promoter is to do that we ask the promoters to pledge their personal assets as well. We ask the corporates to pledge their assets. So it's not just hard plant property and equipment that we are taking as a collateral. We are taking, on top of that, we are taking promoters' personal guarantees as well as the corporate guarantees also. So quickly wanted to give you an example of a, a transaction what we did from a series one. So this is a five-star hotel based in Ahmedabad, right in front of Sabarmati waterfront at the Ashram Road. Promoters, Mr. Karia and his brother wanted to do a brand tie-up with ITC. Like I said, we are only looking at EBITDA positive companies, EBITDA positive corporates. The hotel was up and running, had an operating history of close to 8 to 10 years. Now that they wanted to do a brand tie-up with ITC, right? What ITC told the promoter is that you have to renovate the hotel as per ITC's brand guidelines. The promoter went back, he checked his internal accruals, but the capital expenditure, what they wanted to do initially, the renovation part, what they wanted to do, his internal accruals were not sufficient at that point of time. So what they did is in fact, they have approached to NBFC called India Bulls. They borrowed at a rate of close to 16 and a half odd from India Bulls. And back then in 2019, as we all know, what happened with India Bulls? India Bulls eventually stopped doing their corporate lending, and they were not in a position to give away loans. In fact, they asked the promoter to repay whatever he had borrowed from India Bulls. So promoter had only two options: either to borrow, which typically banks and NBFCs would not lend in this situation because, like I said, they have already borrowed from an NBFC called India Bulls. And today in India, no bank and NBFC can give you an exit, give an exit to another bank or NBFC. You cannot borrow from SBI to give an exit to India Bulls NBFC. You cannot do that. So that is the latest guidelines what RBI has developed in its recent prudential norms. So no bank or NBFC today in the system. Promoter left only with one option is to sell off the entire hotel. At that point of time, the equity value what the promoter got was only 90 odd crores, 90 to 100 odd crores. Had the promoter sold the property at given point of time, the promoter would have settled with no property, right? Paying, and just that he would have just paid India Bulls loan, right? So what we ask the promoter to do is borrow from us at a rate of 22 to 23%. Give an exit to NBFC, which is India Bulls. Okay. Consider this situation as a pseudo profit sharing. In terms of cost of borrowing, we understand it 22 to 23% sounds a lot. But when you look at the counterparties, right? Who is the counterparty? A promoter and hotel which is has an operating history of 8 to 10 years. It's not a distressed call what we took. Well established, up and running hotel, making an EBITDA close to almost 40 to 50 crores. Is just that there was some guardrail which was imposed by RBI stating that you cannot take a loan from a bank just to give an exit to an NBFC. That was the end use. So typically all those six end users what I spoke about, it's it's just that promoters are really good, the counterparties are really good. Because of these prudential norms, latest prudential norms, the promoters are not able to borrow from banks and NBFCs. So we are able to cater their needs. And the biggest risk in this particular strategy is the risk of repayment. It's not the concentration risk, it's not the default risk. Because no promoter, no corporate wants you to stay on their books of accounts for close to 3 to 4 years. The moment they get an access to these banking channels again, they will give us an exit. So here are 7 exits what we have seen so far from this particular strategy. The first one is GMR airports. When we lent to GMR, it was again an non-bankable opportunity that came to us. The promoter wanted funds for their working capital requirement. The promoter went to a bank, and like I said, there is a cap of only 20 lakhs. No bank will give you a loan more than 20 lakhs. However, promoter required some close to 70 to 80 crores. So they came to us and borrowed at a rate of the contracted IRR being at 19%. So that was the contracted IRR, and this particular trade got exited at 19.25. The second trade is we did the the ITC Welcome Hotel, which is right in front of the Sabarmati waterfront, Ahmedabad. The third deal is a listed player again, Branberry. Two FDA approved plants were pledged to us. At that point of time, Branberry did capex. The capex overshot. They wanted money for their working capital requirement, and banks and NBFCs were taking a again here. The very important thing is the kind of due diligence that you do, at what speed you can do. So typically, banks and NBFCs were taking almost 6 months to do the entire DD. So we took this trade. This came to us. We took up this trade. We did the entire DD in a span of 2 months, and we dispersed. The third tranche we lent to the Kohinoor Group, a well-known promoter, a well-known group based out of Mumbai. So we did this particular trade. The fifth one is a company called SPY Agro, based from Nandyal, Andhra Pradesh. The promoter wanted some funds for their working capital requirements. On top of that, the promoter has passed away. Now that his grandson was studying in US, had to come back to India, and during that time, there were few already existing borrowings what they did from HDFC, and while the promoter passed away, they were not in a position to repay the debt. So they were tagged as an SMA2 account. So today in India, any corporate has been being tagged as an SMA2 account or maybe as an NPA cannot borrow from banks and NBFCs. First, he has to come to a special situations fund like us, borrow at a rate of 22 to 23%, service our debt for at least 1 to 1.5 years or time. Then slowly he'll move back to a performing credit fund where he will essentially borrow at a rate of 15 to 16%. The moment he'll show a consistency in making the repayments on time, that's when he will have a banking access again. So that's how the mechanism works. So that was one of the trades. Yes, the last trade is the financial services company. The name of this company is Slice. So Slice was essentially in the business of issuing credit cards, right? A Bangalore-based company was issuing these credit cards for its retail borrowers, was essentially doing short-term unsecured lending. But RBI told this particular entity that you are not a bank, you are neither an NBFC, hence you cannot issue credit cards. Slice had no other option. The only option left was either to shut down the entire business operations or acquire a small finance bank so that they will have an banking license. The moment they obtain a banking license, they can commence their business operations again. So they went on to acquire a small finance bank called Northeast Small Finance Bank. So they have acquired. acquired the Northeast Small Finance Bank. The end use is very simple. The end use is again reiterating the philosophy: bank restricted opportunities. Against acquisition financing, no banks or NBFCs will essentially lend you. So we did this particular trade. So moving to our series 2, it is a 5,000 crore fund. We intend to deploy this 5,000 crores in 25 to 30 companies, different companies. Targeted IRR is 22 to 24%. So everything remains same. The fund's philosophy is same. The investment philosophy is same. Minimum 2x collateral is what we are looking at. All secured investments, investing only in EBITDA positive companies. The only small difference in our series 1 and series 2 is that we are taking a slight equity upside in our series 2. It's not in series 1 we were stick we were st- we were looking essentially looking at only NCDs, but in series 2 we are slightly taking an equity upside in the form of CCDs and OCDs. Yes. This is a 5,000 crore fund, intends to invest in 25 to 30 different companies. And when you look at the concentration risk, losing principal in such strategies is very difficult, because any investor who is putting in 1 crore, his 1 crore is being deployed in 25 to 30 different trades. On an average, 4 to 5 lakhs of his capital will be invested in one particular company. That means your average exposure, right, per portfolio per portfolio company is not more than 5%. Say, for example, today my portfolio is tracking an IRR of 22 to 24%. Tomorrow, it will ideally take almost 50 to 60% of my deals to go burst to bring down my entire IRR from 22% to 10 to 11 odd percent. It's not that one particular deal getting burst will have an impact on my entire portfolio IRR. My portfolio IRR will, however, it will drop by certain bips. It's not that it will drop right from 22 to 0. So any investor who is essentially looking at the safety of capital, yes, Neo has put in its own 200 crores as a sponsor commitment, while SEBI states an AIF fund house shall put in its own 2.5% of its fund size as a sponsor commitment, or 5 crores, whichever is the least. Neo has put in its own 200 crores. In terms of safety of capital, yes, this is the fund for your investors who is looking for to have a safety of capital. Along with that, the regular quarterly payouts, what we do in this particular fund. Talking about series 1, right from the inception of series 1, we did 7 distributions, coupon distributions so far. Last month, on the 7th of July, we did a coupon distribution close to 4%. And this keeps happening. And soon after the commitment period ends, we'll start giving away the principal as well. So that means more or less, door to door, the fund life is 6.5 years, but more or less the economic life of the fund is not more than 4.5 years, because we are taking your money in tranches, in drawdown structure, right? Today, the current drawdown is 15%. Any investor committing a crore has to give us 15 lakhs. Plus, there is a equalization premium what we usually charge, because we have already did our first close in the month of Feb, and right from Feb we did 2 trades in our series 2 as well. I'll explain you the this give will give you a gist of these two transactions as well. So right from Feb to till today, the 2 trades what we did in our series 2 has started accruing interest. So any investor stepping in has to pay a certain premium. What usually investors they do in bonds as well, the CC what they charge, right? So just to make sure, any previous investor and new investor in this particular fund will arrive at par, just to make sure both the investors are at par level. So series 2 5,000 crore fund, Targeted returns are 22 to 24%, invests in 25 to 30 different NCDs, along with a slightly equity upside, is what we are seeing. The first trade what we did in our series 2 is a company based out of Vapi, Maharashtra. The name of this company is Gayatri Shakti. Essentially produces craft papers and duplex bonds. They had set up a new tissue paper factory, and during the time of setup of this particular facility, the capital expenditure overshot. They exhausted their internal accruals. They wanted funding for their working capital requirements. The company is in the phase of drafting its DRHP and will be going to an IPO in next 18 to 24 months. So we are essentially, what I'm trying to say is that it's not the distressed lending that we are doing. It's all good counterparties, good promoters, good corporates whom we are lending to. The second trade is the renewable energy logistics company based out of Tamil Nadu, Chennai. So NTC Logistics holds holds the market command. Almost 50 to 60% of market share is captured by this particular company. So they are essentially into providing this renewable energy transportation services. So promoter what they did is they did some mad stuff. They started doing some backward and forward integration. They had the core business was NTC Logistics, where they were essentially providing this transportation services for renewable energies. In the event of doing that particular business, the promoter thought of doing some backward and forward integration, where they have acquired a company called Srivari, which is in Tamil Nadu. So they were essentially producing this wind turbines. So the company essentially produces wind turbines. So the promoter had acquired that particular company, and moving forward, they have also acquired an EPC company called Ever Renew Energies. So bad time to enter at that particular point of time. The renewable energy sector was not doing really well in 2021. So this is the only case where we have seen a little stressed situation. Apart from that, all the 25 trades what we did, 24 trades what we did, we have seen all stellar counterparties, good companies, promoters having a good intention to make repayments on time. And yes, we have seen 7 exits so far in our series 1. This is the only deal where we have seen a little stress. But like I said, it's not just the plant, property, and equipment that we take as a collateral. We saw the business is in stress, so we asked the promoter to pledge their personal assets. Promoter holds a stake in the holding company called NTC Group. So there he has a stake. We ask the promoter to pledge their shares. We have a certain land parcels of the promoter, which have been slowly pledged to us. At tomorrow, at any given point of time, if we see any threat in this particular business, we try to enforce this particular collateral. And one particular point, for an investor, we are giving a quarterly payout of 4 to 4.5%. It might sound a very good distribution, but for us, for Neo, it's not just a coupon distribution. For us, it is like a risk mitigating framework. It's not that we are having your principal entirely locked throughout the fund life. We are distributing the principal as soon as the commitment period is completed. So we did our first close in Feb 2025 this year. So 3.5 years from today, ideally in September 2028, you will see investors' principal coming back to their bank accounts along with their quarterly payouts. It's we are not encouraging any bullet repayments, nothing. Sectoral caps as defined by SEBI, not investing more than 25% of funds AUM in one particular sector. 10%, 10% is the hard cap per portfolio entity. That means 5,000 is the fund size. We are not investing more than 500 crores in one portfolio company. My average deal size itself is 120 crores, somewhere between 120 crores to 300 crores. that states that how well diverse my fund is, right? My concentration risk has gone down significantly. Default risk try to mitigate as much as possible by not investing in distressed situations, right? So I would like to take a pause for some time, and if there are any questions, happy to answer.
Thank you, Daud. And participants, if you have any kind of a questions, probably you can put it in a chat box. Um, just to summarize this, it's as of now we are seeing a lot much demand of this particular product, or I would say private credit side. Definitely, as Daud said, due to some kind of a, RBI regulation changes, there is a scope, like, private lenders can come in the picture and they can get they can create a good yield or high yield products basically. On the second side, on the other side, from the client point of view, if we think about, then interest rate, last 6 7 months, if we see interest rate has come down. So
Absolutely.
clients are any which ways looking for some kind of a high yield kind of a product, and where this kind of a particular product comes into the picture, definitely it comes in a AIF structure, so the commitment amount would be 1 crore. But as he mentioned that there would be a different drawdown. So as of now, drawdown is 15%. So client needs to give a 15 lakh rupees. Plus, as he said that, some extra because two deals already has happened. And every quarter, I think now there would be some kind of a drawdown would be there for 15 to 20%.
Yes, absolutely. We are trying to call 15 to 20% uh, capital every quarter.
Okay.
So that means any investor who has committed a crore has to has we have already issued one drawdown notice of 15%.
Hmm.
So today any investor who is stepping in is coming with 15 lakhs. So tomorrow we might issue another drawdown notice in the month of September,
Okay.
another 15 to 20%.
Okay.
So we take money in tranches and we give away the principal in tranches.
Okay. So as
Yes,
as you said, like, 4.5% is every quarter is
every
payout is
quarter.
due,
Yes,
or you guys, scheduled for. And then I think December 28 or the principal also will start getting back. A client will
yes,
start getting back the
absolutely.
principal
Yes,
as
yes,
well. And so this is the structure. And as he said that the gross yield would be around somewhere around 20 to 24%, would be invested in approx 25 25 deals probably. So diversification is there. Uh, Yield probably I would say this is like a good structured product where, client can expect a higher yield in this kind of a low interest rate scenario. Diversification point of view, say if one would like to look for, equity may already they are overboarded and they would like to go for a debt. So again, I would say this is one of the product to access a unique opportunity or unique deals they can be a participant or they can invest into. So this is like one thing. And lastly, I would ask you about if one client is, because gross yield आपने बोला 20 to 24% के आसपास,
yes.
what kind of a net yield, I mean, in the hands of investors, what one can expect from this particular product?
So today my portfolio is tracking an IRR of 23%,
Hmm.
series 1. So you deduct the management fee of 2% for an investor who has committed 1 crore.
Hmm.
Okay. So your IRR will come down to 21%, right? So
Hmm.
on 21%, there is a profit sharing, what usually AMC does. So let me just quickly show you the fee structure as well.
Yes.
Yes. So any investor who is putting in 1 crore, there is a management fee of 2%, which will bring down your IRR to 21%. On 21%, we are going to charge a performance fees, basically a profit sharing. So on 21%, we are going to charge 17.5%. That means close to 3.4%. So net of expenses, pre-tax, your investor will land around 17.5 to 18%. So a debt fund giving you 17.5 to 18% returns And these returns are non-correlated returns, nothing to do with market volatility. Despite after having the rate cut of close to 1%, right? So nothing has affected. What we did in this series 2 is that fund manager Mr. Rubin Cheda and Puneet Jain has anticipated the rate cut way back in the month of in the year of 2024. So they started taking a slightly equity upside as well, because any new NCDs what we are subscribing will essentially will not attract a good returns, right? So despite having a rate cut, we see a small delay in returns in NCDs, but that is the reason we started taking an equity upside in our series 2. So net of expenses and pre-taxes, 17.5 to 18%, that too from a debt product, nothing to do with markets volatility, right? Non-correlated returns. Despite having the rate cuts giving you similar returns, today you'd see any category 3 AIF or debt PMS, the gross yields have gone down from 13-14% to 11 to 12% after the after the rate cut, what recently happened. So, good strategy, nothing to do with market volatility, comes with safety of capital, well diversified fund, principal payout along with interest payout along with principal payout happening in this particular strategy. Principal eventually will start coming to your a client's account from December 2025 from a series 2. In series 1, we have already invested in 24 to 25 trades. We are continuously distributing the coupons right from the inception. Principal will start kicking back to investors account from next year June 2026 in our series 1. So yes, a good fund giving you a returns of almost equivalent to a large cap fund, right? Historically, if you look at a large cap funds in India, Nifty 50 has given an average IRR of 13 to 14%, right? Over the span of 10 years. Talking about a 10 years, taking a time horizon of 10 years, Nifty 50 has given close to 13 to 14%. So a debt product giving you an equity like returns is, I think so, someone should explore along with safety of capital, regular cash distribution happening, yes, and diversification. So net of expenses and taxes, assuming that your investor who is putting in 1 crore falls under the highest tax bracket of 39%, will net land around 12%, having an IRR of 12%. So as an AIF, category 2 AIF, we do not have any taxation at the fund level. So it's just that we will deduct the management fees, OPEX, and the performance fees. Net of expenses and pre-taxes returns is what we will generate, essentially 17 and a half to 18%. And the rest, it is in the hands of investors as per their applicable tax bracket. Corporates can invest, resident individuals can invest, partnership firms can invest, US and Canada based citizens can invest via gift city route in this particular strategy.
Okay.
There is only a 10% or TDS what we deduct at a fund level. That too can investors can claim just by filling up the form 26AS.
Perfect, Daud. Thank you so much for explaining in a very layman language, in the simple language, what this product is all about and highlighting the key features of the product. And participants would request you kindly go through. We have sent a mail as well on this particular product. So go through the presentation. In case try to speak with your clients. In case you get any kind of a positive response, can connect with us centrally. I will be happy to connect with your clients. So thank you, Daud. Thank you so much for your time. And
Thank
thank
you
you,
so much, Ritu.
participants.
Thank you so much, team. Thank you so much.
Yes,
Have a nice day.
you too.